It is the beginning of earnings season in earnest, with a lot of the big banks reporting their numbers this week, sort of kicking it off. So we wanted to sort of set the table for what folks can expect. On average, according to FactSet, we're looking for earnings from S&P 500 companies to have risen 64% in the second quarter. That would be the highest growth rate in more than a decade. And of course, as I mentioned, we're coming into earnings season with stocks at record highs here. But guys, it's at least sort of on the more animal spirit side of things, it feels like people are looking past this quarter. Yes, of course, they're going to be paying attention to numbers, but as we tend to say, and perhaps even more so this time, they're going to be paying attention to forecasts. It feels like, if the last couple of weeks' theme is any indication, that people are not so much focused on the blockbuster economic growth that we're seeing right now, but looking at past peak and seeing the slowdown that's coming on the other side of the slope. And I wonder if that is also going to be true for earnings, and if people are going to be looking for any signs that the party is slowing down to some extent. Myles, what do you think?
Yeah, I mean, I think what's been interesting to watch the market grinding higher over the last few weeks or so is that we still are waiting for that big multiple compression that we talked quite a bit about only a few months back. This idea that the multiple on the S&P 500, which today, on a next 12 months basis, stands at around 20, 22 times forward earnings, depending on exactly how you cut that. We had seen a lot of commentary that that multiple could come down to as low as 17 times forward earnings. And what that means, basically, you need earnings to come up if the level of the index is to remain the same. And I think what we have started to see in the last few weeks is maybe an idea from investors. And I think it's really, of course, driven by what's happening in the bond market. Maybe this idea that at 1.25 on a 10-year, 22 times earnings is fine. I mean, and I think a lot of that multiple compression is predicated on the idea that because of this higher growth trajectory, because the economy is doing so well, you would see a sustained elevation in longer term treasury yields. Obviously, that is really not what's happened at all. And I think, especially given, Sozzi, what we saw in some of the big cap tech names last week, I'm going to be very interested to see, sort of what leadership looks like through earnings season, because, we can talk about, it's only a few names propping up the market. But if all the FANG names are getting involved here as market leaders, it's going to be very difficult, I think, to tell, a bearish story about where stocks are headed. Again, just because now you're going to have four $2 trillion companies leading the way higher. Just the construction of the S&P says that that's going to, on balance, going to be positive just for the index's level going forward.
Yeah, no, that's a real good point there, Myles. And I have a little bit of an investor checklist here for earnings. Probably three things that all folks should mention, and certainly I think hits upon some of the things you mentioned there in terms of big cap tech stocks. First up, which companies are preserving their profit margins? Goldman Sachs out this morning noting that S&P 500 profit margins hit a record high last year despite the pandemic. So if you are trading earnings season, you're investing into earnings season, you want to favor those companies that have been growing their margins last year, but also have the prospect to grow them this year. And that's very important to see in this type of environment where you're seeing inflation in labor, inflation in raw materials. Can companies expand their profit margins? So very key thing to watch as you're going through a company's corporate earnings report. Next up, how are companies spending cash? Goldman also out noting the cash relative to total assets on the balance sheets of companies are at record levels. So I wouldn't be surprised as companies start to report earnings over the next few weeks. You hear plans of dividend increases, double-digit increases, also large increases in share repurchase programs. A lot of those repurchase plans, they were kicked back into gear late last year, and a lot of companies came out. They spent a lot of money to buy back their beaten up stock price. So I wouldn't be surprised if you see companies come out, raise or just issue new share buyback plans. And then last but not least, what type of uncertainty is baked into corporate outlooks? Julie, you and I have debated this back and forth. Is this the quarter where companies say, you know what, chances are the Biden administration is going to raise taxes maybe next year, early next year? Do we come out now and guide to the street on that potential profit impact?
Yeah, it certainly feels like the tax debate. Well, obviously it's going to continue indefinitely, but the fervor with which we had it has died off a little bit. Sozzi, I just wanted to circle back a little bit to that that shareholder return component. There's some data out of Deutsche Bank that while the trailing 3-month announcements for buybacks is still not where we were pre-crisis, just in the last week, on a 1-week basis, we saw I think it was about $145 billion in announced share repurchase plans, and that recovers the full pre-pandemic, or recovers to the full pre-pandemic level. And so you've started to see that appetite for more shareholder return. I think obviously the buyback story in the last decade is going to be more aggressive here relative to where the dividend story has gone, just because of the way that modern companies decide to reward their shareholders. Buybacks, of course, very much in favor. And so to see those announcements accelerate, and I guess the timing on that implies that they were sort of pre-announcements, or after you square up the first half of the year, even outside of your earnings announcement, you come out. And I guess really it was, because the banks were able to come out and do that. But just interesting to see that activity get back to its pre-crisis level.
Yeah, and that activity is happening at one of the groups that's reporting this week in particular. That's the banks. We just got some clearance from the Federal Reserve for some of the banks to return more capital to shareholders if they like. You're looking there at the year-to-date chart of the XLF, the ETF that tracks the financials broadly. As you can see, it's up about 24.5%. It's down about 4.5% from its high back on June 4th. And really here, the theme that's likely to emerge from the banks is, on the one hand, trading activity was down last quarter. On the flip side, M&A activity, listings activity doing pretty well. So that side of the business likely held up well. But it'll be interesting as well for the more consumer-focused banks. Goldman here, more a trading-focused bank, investment bank. It'll be interesting to hear what they are saying about consumers. We just got the news last week that Wells Fargo is going to stop offering personal credit lines, and is indeed going to close lines of credit, personal lines of credit, for its existing customers. So any more color on that is also going to be really interesting from Wells, you guys.
Nice change for them on closing lines of credit. Sorry.
Right, unless
everyone was waiting for it. Everyone was waiting for it. Someone had to come out and do it. And, I'll take the heat if I get a mean PR email later.
All right. That's an invitation, ladies and gentlemen. All right.